As of August 2024, the US economy faces a complex and evolving situation regarding the potential for a recession. The outlook remains mixed, with varying predictions depending on the source. On one hand, the Federal Reserve's recent decision not to forecast a recession in 2024 marks a significant shift from previous expectations. The Fed's staff now believes that the US economy might avoid a downturn, bolstered by factors such as steady consumer spending and a resilient labor market. Looking ahead, the Federal Reserve's monetary policy decisions will play a critical role in determining the US economic trajectory. With inflation showing signs of easing, the Fed might adopt a more cautious approach to further rate hikes, potentially reducing the risk of a recession. However, any unexpected spikes in inflation or disruptions in global markets could force the Fed to reconsider its stance, potentially leading to economic contraction. Global economic conditions remain a significant wildcard. The potential for further economic slowdowns in major economies like China, coupled with ongoing geopolitical tensions, could negatively impact US exports and business confidence. Additionally, any escalation in the Ukraine conflict or energy market disruptions could lead to renewed inflationary pressures, complicating the Fed's efforts to balance growth and inflation. Ultimately, while the US has demonstrated considerable resilience, the balance between domestic economic factors and global uncertainties will likely dictate whether the economy can avoid a recession. Policymakers, businesses, and consumers alike will need to navigate these challenges carefully to sustain growth and maintain economic stability in the months ahead. However, this optimistic view is not universally shared. The yield curve, a reliable historical indicator of recessions, suggests a 61% chance of a recession within the next year. This metric, which reflects the difference between long-term and short-term Treasury yields, has been a strong predictor of past economic downturns. Contrary to the Fed's optimism, consumer sentiment and corporate perspectives are more cautious. Surveys indicate that 69% of consumers expect a recession, reflecting concerns about inflation, rising interest rates, and economic uncertainty. CEOs, while slightly less pessimistic than earlier in the year, still prepare for a potential downturn, with 84% expecting a recession in the next 12 to 18 months. The labor market, traditionally a strong pillar of economic stability, is showing signs of softening. Job growth has slowed, and there are concerns about potential increases in job cuts. This cooling of the labor market could lead to reduced consumer spending, further dampening economic growth. Additionally, while household debt has increased, delinquency rates have stabilized, indicating that consumers might still be in a position to support the economy, but any significant job losses could change this outlook quickly. In the financial markets, there's been a noticeable shift in sentiment. Goldman Sachs recently lowered its recession probability for 2024 to 15%, reflecting confidence in a soft landing scenario, where the economy slows without entering a full-blown recession. However, other institutions like Bank of America remain more cautious, assigning a 35 to 40% chance of recession. Overall, while there are positive indicators suggesting the US might avoid a severe recession, significant risks remain. Factors such as continued high inflation, potential further interest rate hikes, and global economic uncertainties, including the impact of China's economic slowdown, all contribute to an uncertain economic future for the United States. As the situation develops, close attention will be paid to key economic indicators, particularly in the labor market and consumer behavior, to gauge the likelihood and potential severity of any recession in the coming months. In recent months, the debate over whether the US will enter a recession has intensified. Various economic indicators provide mixed signals, making it challenging for analysts and policymakers to reach a consensus. One of the most significant indicators is the yield curve inversion, which remains a key point of concern. Historically, an inverted yield curve has been a reliable predictor of recessions, as it suggests that investors are more concerned about the near-term economy than the long-term outlook. Currently, the spread between the 10-year and 3-month Treasury yields suggests a 61% chance of a recession within the next 12 months, a signal that has economists and market participants on alert. Despite these concerns, the US economy has demonstrated surprising resilience. The Federal Reserve, which previously anticipated a recession, has shifted its outlook, no longer predicting an economic downturn in 2024. This change in stance is largely due to the sustained strength in consumer spending, which has been supported by a robust labor market. Even though job growth has slowed, unemployment remains low, and wage gains have helped sustain consumer demand. However, the labor market is beginning to show cracks. Recent data indicates a slowdown in job creation, and there are growing concerns about potential layoffs, particularly in sectors such as technology and finance. Analysts warn that if job cuts increase significantly, it could lead to a reduction in consumer spending, which has been a key driver of economic growth. The potential for a downturn in consumer spending adds to the uncertainty surrounding the US economic outlook. Consumer sentiment has also been increasingly cautious. Surveys reveal that a significant portion of Americans expect a recession in the near future. This pessimism is driven by concerns over inflation, which remains elevated despite the Federal Reserve's aggressive interest rate hikes over the past year. Although inflation has shown signs of moderating, it is still above the Fed's target, leading to concerns that further rate hikes might be necessary, which could stifle economic growth. The financial markets reflect this uncertainty. While some investors and financial institutions, such as Goldman Sachs, have become more optimistic, lowering their recession forecasts, others remain cautious. Bank of America, for example, still sees a substantial risk of a recession, with their analysts assigning a 35 to 40% probability. This divergence in views highlights the complexity of the current economic environment. Household debt is another area of concern. While delinquency rates have stabilized, indicating that consumers are still managing their debt levels, the overall increase in debt during the second quarter of 2024 could become problematic as the labor market weakens. Higher debt levels combined with a potential rise in unemployment could lead to a decline in consumer spending, further increasing the risk of a recession. Inflation remains a double-edged sword for the economy. While it has moderated from its peak, it is still high enough to erode purchasing power, especially for lower-income households. The Federal Reserve's efforts to combat inflation through interest rate hikes have had a cooling effect on some sectors, particularly housing, where higher mortgage rates have dampened demand. However, these rate hikes also pose the risk of slowing the economy too much, potentially tipping it into a recession. The global economic environment adds another layer of complexity. The slowdown in China's economy, coupled with ongoing geopolitical tensions, could have ripple effects on the US economy. China's economic struggles, particularly in the real estate sector, could lead to reduced demand for US exports, impacting American businesses that rely on international markets. Additionally, the ongoing war in Ukraine and the resulting energy crisis in Europe could have indirect effects on the US economy. While the US is less dependent on Russian energy than Europe, the global nature of energy markets means that higher energy prices could contribute to inflationary pressures in the US, complicating the Federal Reserve's efforts to bring inflation under control without triggering a recession. Corporate earnings reports provide another important clue about the health of the economy. While some sectors, like technology, have reported strong earnings, others, particularly in consumer goods and services, have shown signs of strain. Companies facing higher input costs and slowing demand may cut back on investments and hiring, which could contribute to an economic slowdown. The housing market, which has been a significant driver of economic growth in recent years, is also showing signs of cooling. Higher interest rates have made mortgages more expensive, leading to a decline in home sales and construction activity. This slowdown in the housing market could have broader implications for the economy, as it affects related industries, such as home furnishings and construction materials. Despite these challenges, there are also reasons for optimism. The US economy has proven to be remarkably resilient in the face of multiple shocks over the past few years, including the COVID-19 pandemic, supply chain disruptions, and geopolitical tensions. This resilience, coupled with strong consumer spending and a robust labor market, has led some analysts to believe that the US could avoid a recession or experience only a mild one. Moreover, there are signs that inflationary pressures may be easing. The recent moderation in inflation could allow the Federal Reserve to pause its rate hikes, reducing the risk of an economic downturn. If inflation continues to trend downward, it could restore consumer and business confidence, supporting economic growth. Fiscal policy also plays a crucial role in shaping the economic outlook. With the US heading into an election year, there may be increased pressure on policymakers to support the economy through fiscal measures, such as infrastructure spending or targeted tax cuts. These measures could help offset the negative effects of higher interest rates and sustain economic growth. In conclusion, the US economic outlook for 2024 remains highly uncertain, with risks of a recession still present despite some positive indicators. The divergence in views among economists, financial institutions, and consumers highlights the complexity of the current economic environment. While the US could avoid a severe recession, much will depend on how key variables, such as the labor market, inflation, and global economic conditions, evolve in the coming months. As the year progresses, close monitoring of economic data will be crucial in assessing the likelihood and potential severity of any economic downturn. Thank you for watching, and don't forget to smash that subscribe, like, and notification bell for more global finance breaking news.